Hey, everybody, and welcome back to Milkshakes Markets Madness. My name is John Kutsmeda. This is Brent Johnson. We're here to bring you a flash update. We're going to talk about some of the things that have gone on in the last 24 to 48 hours. If you're new to the show, please visit us on the YouTube channel at Milkshakes Pod. There's more videos there that'll kind of help you better understand our macro views and some of the things that we talk about. Everything's broken into segments to make it easy for you. This, of course, would be part of the flash update segment. So, Brent, why don't we just hand it off to you? Obviously, CPI is the big thing to talk about, but probably bigger than just the data itself was the massive market response.
Yeah, so I think the best way to do it is set it up, even going back a week or two on our weekly updates. We said going into the Fed meeting that it wouldn't surprise us if the market took the Fed meeting as dovish and we got a bounce for a couple of weeks. But I said, again, that was 2 weeks ago now, said that if there was a bounce out of the Fed meeting on some dovish talk and then some subsequent dovish data, that I wasn't sure it would last. And I think that's kind of right where we're at right now. We had CPI came out this morning, and it's not that it wasn't extremely low, but it missed pretty consistently on all the different readings that came out. And based on the Fed's talk about they were dovish, and while there still could be some hikes down the road, that they had made a lot of progress. And so, everybody took that as data dependent, and, Powell kind of reiterated that. And so as the data comes in, as it's soft, the market's reacting. And I think the market is reacting correctly to what he has said, and it's acting correctly based on the data, based on what he said. But the magnitude of the moves, in my opinion, is again just getting way ahead of itself again. So I'm not surprised that we've had this bounce again. We talked about how that could possibly happen, but I'm a little surprised. I'm never shocked, but I'm a little surprised at the magnitude of the move coming out of the Fed meeting. So if you remember, October markets were down anywhere from 7 to 10% in October, depending on kind of which market you're looking at. Most of that's recovered already. So markets are up like 9 to 10, 11% since the Fed meeting. And again, I'm not surprised by the bounce, but I think the market's gotten way ahead of itself. And what I would say is, we still have a lot more data that comes out between now and the next Fed meeting. Tomorrow we have retail sales and a bunch of PPI. So this move today, it could be gone in 24 hours, right? And as we get into next weekend, more information comes out. It could fall further. Now, I think one thing to talk about, though, is even if we give some of this back, it doesn't necessarily mean we're going to crash either. So when I say that I don't think that the market, or I think the magnitude is just too much, I don't necessarily think the market should have crashed on any of this news. I'm not saying that. I'm just saying that the magnitude is too big. So it wouldn't surprise me at all if we just kind of pull back a little bit and just kind of go violently sideways into the end of the year. But I will say this. I would be surprised if at the end of next week, so 10 days from now, I would be surprised if the equity markets are higher than they are right now. So I think at best, I think they probably go sideways for the next 10 days. And I think it's more likely than not that some of these gains have given back. Again, not because now we're going to crash, but just because I think the reaction has been an overreaction to the data that's came in. If the data had come in and if it had severely missed, and inflation was crashing, then I can kind of see it. But I mean, this reacted as if the inflation expectations just fell off a cliff, and they really didn't. They just came in a little bit soft. So I think it's going to be pretty interesting to see what the data says for the next of the week and into the next week, and it's going to be even more interesting to see how the markets react.
Well, the dollar milkshake theory, which you're very well known for, anyone who doesn't know what that is, you can learn more on the channel. But it's a long-term story. It's a long-term thesis. It's a long-term view. I'm not sure what to think. You're getting more and more confident in making these short-term calls where we got a 10 day prediction from Brent.
well, okay. So I'm actually glad you brought that up because, every now and then I'll make these calls and every now and then I'll post a trade on Twitter. And the reality is that the big positions for us don't change that often. I think we've talked about that before. So for anybody that's new, our asset allocation doesn't typically change a whole lot. We will hedge things from time to time, and we'll buy calls from time to time to, press the bet. But by and large, our overall allocation doesn't change that often. That said, I am perfectly happy to do short-term trades against our long-term thesis. So as an example, last week, we had been short oil. Last week when oil was around 76, we bought oil. We sold it today just short of 80. So that was it. Again, that's a tactical trade that we did, and again, I posted that on Twitter, so I'm not making this up. These trades that you'll hear me say, I think this is going to happen, and I think that's going to happen. Again, when I say that I think those things are going to happen, that doesn't mean that I'm necessarily turning over my entire portfolio to prepare for it. It's just, again, so when I give a prediction, I'm not saying everybody should go out and sell stocks here because they're going to be down 10 days from now. I think that they will be down 10 days from now, but that doesn't necessarily mean that's the appropriate thing for you to do. So it's one thing to remember is I'm happy to give my opinion, but please don't take it as financial advice.
We have a disclaimer. If you guys stick around long enough, it's at the end of our videos. But the point to here that is worth reiterating, we had some fun comments on our last weekend episode where someone had made the point that we're always emphasizing the dollar. And it's like, well, of course, it's the whole argument here. And that if every week, we, or particularly you, was coming out with a new hot theme of the day, then it would undermine everything that, you've built your portfolios around. And, one of the things that we try to do consistently on this channel is get people to understand the aspect of timeline. And you know what, at the same time, what's always been kind of fun is pushing back when people say, hey, you're just an endless supporter of the dollar no matter what happens. And you're like, well, no, this is the theme that I've come up with. This is my thinking. And so far, I haven't been proven wrong. Yet there's people who've been pounding the table that the only thing you should own is gold and silver for 20 years. And those things haven't really performed well. So it's important to kind of remind people here that there's a reason you take the approach that you do. There's a strategic approach, and then there's these intermittent tactical things. Now, I don't want to turn this into a long form discussion on that. I just wanted to kind of hover over it. Let's go back to CPI, the data. You mentioned PPI, so producer price index. It's kind of almost like more like an inflation forthcoming indicator. Like, hey, what are these manufacturers and producers spending or needing to spend to get the goods that they need? But with that in mind, you're kind of saying, hey, we've got a bunch of data coming out in the next day or so, in the next 10 days, that could put a little bit of a tailwind on this rally. But at the same time, if we see PPI reflecting what we just saw in the CPI, the consumer price index, then this rally could just be getting started.
Yeah, absolutely. And again, I think it's important to understand that, again, I'm happy to give my short-term views, but we've been long equities for years. And if we go back to when I first started talking about this dollar milkshake theory, and let me say this, the reason we talk about the dollar all the time is because I take a very big picture macro view. And I don't think that if you can get the macro view correct without getting the dollar correct, or at least it's very hard to get the overall macro view correct if you don't understand what's going on with the dollar. To me, it's the most important variable in macroeconomics. And so today, that was the biggest one-day down move for the dollar all year, the biggest move since last November when the dollar had its big pullback last November. Again, I think the move directionally was the right one. If the data, continues to come in dovishly and miss on inflation expectations, I would expect the expectation for further rate hikes to fall, and I would expect the dollar to sell off on that. And perhaps maybe the dollar sells off for a month or two. I don't know. But what I do know is that the rest of the world is in the same situation we are. And so if we end up having to, no more hikes and start to do cuts, well, Europe's going to have to do it too. And Britain's going to have to do it too. And Japan's probably going to have to do it too if we are doing it. And so, while you can have these short-term pullbacks in the dollar, I don't think we can get out of this so-called debt crisis that I foresee coming, or this currency crisis coming, without the dollar going higher. Now, whether that happens over the next 6 days or it takes another 6 years, I don't know. I'm not smart enough to know that. But what I do know is that no problem has been solved by CPI coming in soft today. But to your point, if the data continues to come in dovishly, and deflationary reads come in that inflation is falling, then yeah, we could absolutely get a tailwind into the end of the year, into the first quarter. I think that would almost just kind of go with our entire theme for the whole year, which has been violently sideways. Now, overall, the markets have been up, but really, with the exception of just if I think markets were up in January, June, second half of July, and now the first part of November. But everything else has just kind of been sideways and down. And so, I actually think that the next 6 weeks into the end of the year are going to be a fractal of the whole first, 10 months of the year. I think we're going to go violently sideways. I think we're going to have movements down. I think we're going to have rallies, but I don't think it's going to be smooth sailing, melt up into the year. And if I'm wrong, then the assets that we own will melt up into the end of the year. The hedges that we have will, be drawn down, and we'll make money, but we'll probably trail the overall index.
All right. So the CPI, I didn't catch the year over year. I was more focused on the month to month, but the month to month came in at 0.2. Yep. Just underneath the 0.3 expectation. I mean, we're really close to flat, and who knows, before long, we're now in a deflationary environment where that CPI print's coming negative. So it's definitely something, to keep a close eye on. Now, you have been making the point very clear that a big part of the dollar's rally this year has been the fact that interest rates are rising, and that higher yield being paid by the U.S. government is attractive. It's drawing in capital to the U.S. markets, partly giving a boost to equities, definitely giving a boost to the dollar. Now, if this is it, if the Fed is done raising rates, I guess this is kind of bringing in two themes we've been talking about. Because in addition to this higher rate, higher dollar theme, there's also been this conversation we're having around animal spirits, the market kind of front running the Fed, and you making the point that the market is actually doing a favor to the Fed. It's doing kind of the rate cuts for the Fed. So why would they even need the cut if the market's rallying? So with both of those caveats in mind, what if this is it, right? Like there's enough juice in the market where the Fed doesn't need to raise, but the Fed also doesn't need to cut for a while. And we kind of do this violently sideways, this fractal of the year. But eventually something happens and the Fed needs to cut and become more accommodative. Let's say that response is very, very aggressive and we see huge cuts. We're at 550 now. Maybe we're down to 300 basis points in a couple quick Fed decisions. Would you say then potentially the top is in for the dollar in this cycle?
Well, I think that sort of, but I need to caveat that. And here's the reason is if the Fed is cutting, the Fed is going to be cutting because liquidity is drying up. And if liquidity is drying up, then the dollar is surging, right? So the Fed is not going to come out and start cutting just out of the blue. Now, if markets are selling off and, spreads are widening out and the VIX is rallying and, the dollar is getting squeezed higher, that is what would cause the Fed to come in. So let's say, I think the dollar's around 104, 105 right now. Let's say it surges to 108 or 109. Markets are down 10 or 15%. Maybe they're a little bit lower than they were 3 weeks ago. Spreads have widened out and the VIX is at 30, something like that. Then I could see the Fed coming out and cutting or something like that, right? But again, then the dollar would be falling then from a higher level than it is now, I think. Now, what I think is more important to focus on is the fact that let's say I think it's most likely, and again, I'm not certain of anything, and this isn't necessarily a prediction, but I think it's more likely than not that they're not going to raise anymore. And part of I don't think they have to raise anymore. And I think Powell has been pretty clear on this, that if we just sit where we're at and let the lag effect catch up with all the front end loading that we did on the hikes, that in itself is going to be tight. The quantitative tightening will continue to take place. With the long end being higher now as people move forward in time, and they continue to, and all the debt that's out there continues to get refinanced now at 5.5% rather than 3.5% or 2.5% or 1% or whatever it was at. That itself has a tightening effect. And so I think it's very possible that the Fed doesn't have to hike anymore, but if the market continues to try to front run a cut and continues to stay at these levels or higher, and we get that long end refinancial tightening, due to the lag effect, to a certain extent, the Fed doesn't need to do anything, right? I mean, again, why would they have to raise in order to slow the economy? Again, I think if we just sit here and if the Fed doesn't do anything for another year, a year from now, financial conditions would be much tighter than they are today, or at least they should be much tighter than they are today, assuming the extension of new credit does not take off in some kind of a surge. But as credit gets re-extended or refinanced, again, it's going to be at much higher rates than it was before. That's going to have the tightening effect. And that could eventually cause some of the volatility that we're talking about, the drawdown in asset prices, that could then force the Fed to step in and start to loosen monetary policy. But again, one thing I would caution people about is this doesn't have to start in the United States. And I would argue that it's just as likely that whatever crisis or mini crisis or volatility spike or spreads widening that we have could easily start outside the United States. There's nothing that says it has to start inside the United States.
Well, there's a lot to unpack there. We'll give you guys a few days to do that before we come back with another flash update or our regular weekend update. We appreciate everyone joining us. Brent, we appreciate you giving us your thoughts on that. We'll see what transpires. And as far as credit growth and loan growth, I think I saw a chart that shows that for the first time in a dozen years or so, loan growth is actually negative. So it doesn't seem like inflation is going to be coming from that side of the aisle. We'll see what the Fed does with the rest of the data leading up to their next FOMC. Until then, let's keep having fun with the markets and see what the rest of the week holds.
Sounds good. I'll leave everybody with just a quick thought. 2 weeks ago at the end of October, when markets were down 10%, how many of you thought to yourself, gosh, I wish back at the end of September, when equities were at their high and VIX was at its lows, I wish I had just bought a few puts when they were cheap. Well, we're right back where we were at the middle to end of September. So just keeping that as mind. If you've had a good year this year, we've got a couple of months to go. VIX is at 14. It was at 23 2 weeks ago. Nothing to say it couldn't go back there pretty quickly. So just keep that in mind as you're looking out into the future.
So basically, Brent is encouraging you guys to maybe buy a little bit of defense. Maybe. So, all right, look, you can argue with him on whether that's the good call right now. He did post an interesting chart on Twitter highlighting that move and the opportunity to buy some cheap defense, some puts, and take some chips off the table, if you will. You can find all of that on his Twitter account at Santiago AU Fund. You can find me at John Kutsmeda. You can find this show at YouTube and Twitter at Milkshakes Pod. That'll do it. This flash update turned into a midweek update, but hopefully you enjoyed it, and we'll talk to you guys real soon. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.